Stop looking at the flashing red numbers on the New York Stock Exchange ticker. Stop looking at the distraction of political theater in Washington. Look at the 10 empty chairs in a mining cafeteria in Sinaloa. Those 10 missing engineers are the only signal you need to understand that the global supply chain has just suffered a fatal stroke. In the last 48 hours, the illusion of a seamless global market has been shattered by a single kinetic event in the Pánuco district of Mexico. While the algorithms in Chicago are busy trading paper contracts that claim to represent silver, the physical reality of silver extraction has been seized by actors who do not care about the spot price in London. This is not a crime story. This is a supply shock that no amount of money printing can solve. The extraction of 10 key personnel from the Vizsla Silver project is not a random act of violence. It is a strategic acquisition of assets by an organization that has realized a fundamental truth of the new economy. When the price of silver crosses the threshold of $100 per ounce, a silver mine becomes a more valuable sovereign asset than an oil field or a poppy field. We are witnessing the informal nationalization of the world's largest silver belt, and the markets in the West are completely blind to the fact that their supply line has just been severed. But this kinetic event in Mexico is only the surface fracture of a much deeper geological shift. If you think this is isolated to one company or one region, you are operating on obsolete data. The silence in the Pánuco mine is about to cause a deafening scream across the entire industrial complex of North America. The data we have received indicates that the Vizsla Silver operation was not just a speculative venture. It was a critical node in the supply of high-grade silver required for the next generation of electronics and energy infrastructure. By removing the technical leadership, the geologists, the engineers, the security specialists, the kinetic actors in Sinaloa have effectively turned off the tap. The government of Mexico has responded by deploying 1,500 troops to the region, but this is a futile gesture. You cannot mine silver with a tank. You cannot run a complex geological survey with a soldier standing guard over every drill hole. The operational risk has now exceeded the threshold of viability. This means that the silver that was promised to the refineries in Canada and subsequently to the factories in the United States simply will not arrive. It will stay in the ground, or worse, it will be extracted and diverted into a shadow supply chain that flows east, not west. This diversion of physical flow is the mechanism that will break the pricing model of the COMEX. For decades, the price of silver has been determined by the exchange of paper futures contracts in New York. These contracts are leverage. They are promises. They are predicated on the assumption that if a buyer demands delivery, the metal can always be sourced from somewhere. That assumption died in Sinaloa this week. When the cartel asserts sovereignty over the resource, they do not hedge their production on the futures market. They do not care about the margin requirements of the CME group. They deal in physical possession. If the Western supply chain cannot secure the safety of its personnel, it loses access to the resource. It is that simple. The physics of the situation are undeniable. You have a massive demand shock coming from the solar industry and the electric vehicle sector, meeting a kinetic supply shock in the primary extraction zone. This is the definition of a market failure. The paper price may fluctuate based on the whims of the Federal Reserve chairman or the strength of the dollar index, but the physical price is now being set by the cost of security and the risk of abduction. The premium for immediate delivery is about to detach completely from the paper price. However, the seizure of the Pánuco project is just the detonator. The explosive charge is located further north in the refining capacity of North America. We must connect the dots between the silence in Mexico and the paralysis in Quebec. At the same time that the mines are being seized, the processing facilities are facing their own existential crisis. The suspension of capital investment into the Horne Smelter means that even if the ore could be extracted from Mexico, there is nowhere for it to be processed efficiently within the North American continent. We are looking at a pincer movement against the industrial sovereignty of the West. On the southern flank, the raw material is being held hostage by non-state actors. On the northern flank, the refining capacity is being strangled by regulatory mandates and capital strikes. The result is a hollowed-out middle where the United States sits, hungry for metal it cannot mine and cannot refine. This is not a recession. This is a structural amputation of the industrial base. The technology companies that rely on a steady stream of silver, the makers of guidance chips, solar panels, and medical devices, are staring into a void. They have inventory for weeks, perhaps months, but they do not have inventory for a permanent disruption of the primary supply belt. Why is this happening now? The timing is not coincidental. It is a rational economic response to the devaluation of fiat currency. The actors in Sinaloa are rational market participants. They see that the purchasing power of the peso and the dollar is eroding. They see that silver is a store of value that is rapidly appreciating. By seizing the means of production, they are converting their operation from a trafficking enterprise into a resource-backed holding company. They are doing exactly what the central banks of the BRICS nations are doing, but they are doing it with kinetic force rather than diplomatic agreements. They are accumulating hard assets. The kidnapping of the technical staff is a method of acquiring intellectual property and leverage. It is a negotiation tactic. They are signaling that if the West wants the silver, the West will have to pay a toll that is far higher than the spot price listed on the Bloomberg terminal. This is the new cost of doing business in a world where the rule of law has retreated. The premium you pay is no longer just for transport and refining. It is for the physical security of the human beings who dig the metal out of the ground. You must understand the scale of what has been lost. The Vizsla Silver project was not a small artisanal mine. It was a high-grade development positioned to be a major contributor to the global supply deficit. Its removal from the equation deepens that deficit to a critical level. The deficit in silver was already structural, driven by the relentless consumption of the metal in green energy technologies. Now it is acute. The market was tight. Now the market is broken. When you remove a primary source of supply in a deficit market, the price does not just go up linearly. It goes vertical. It creates a vacuum that sucks in all available inventory from the surrounding areas. We will see a run on physical bullion not just in Mexico, but in the vaults of London and the warehouses of Shanghai. The smart money knows that the new production is offline. Therefore, the existing stock is the only game in town. This realization will trigger a scramble for possession that will make the bank runs of the past look like polite, orderly queues. The bullion banks that have sold unallocated silver to their clients are now facing a nightmare scenario. They have sold claims on metal that is currently under the control of armed factions in the Sierra Madre. But the most terrifying aspect of this situation is the impotence of the financial authorities. The Federal Reserve can print trillions of dollars. They can bail out the bond market. They can guarantee the deposits of every failed regional bank. But they cannot print a single ounce of silver. They cannot print the safety of a mining engineer in Sinaloa. Their tools are purely monetary, while the problem is purely physical. This is the point of failure for the entire Keynesian experiment. When the crisis is driven by a lack of liquidity, the central bank is God. When the crisis is driven by a lack of physical molecules, the central bank is irrelevant. The markets are beginning to smell this irrelevance. That is why we are seeing the bifurcation of the price. The paper price reacts to interest rates. The physical price reacts to reality. And reality just took 10 hostages. The gap between these two prices is the spread of truth, and that spread is widening by the hour, widening. Those who hold paper contracts are holding a claim on a system that no longer controls the underlying asset. Those who hold physical metal are holding the asset itself, independent of the chaos in the supply chain. Let us look deeper into the mechanics of this seizure. The target was specific. They did not take the laborers. They took the engineers, the geologists, the security specialists. This indicates a high level of intelligence and planning. This was not a random act of terror. It was a decapitation strike against the operational capability of the company. Without these specific individuals, the mine cannot function. The geological data, the engineering plans, the security protocols, all reside in the minds of these 10 people or in the systems they control. By removing them, the cartel has effectively frozen the asset. They have turned a billion-dollar valuation into a hole in the ground that no public company can touch. This renders the stock of the company worthless in the immediate term, but it makes the silver in the ground infinitely more valuable to whoever controls it. This is a transfer of wealth from the shareholders in Toronto and New York to the warlords in Sinaloa. It is a direct expropriation that bypasses the legal system entirely. And because the silver price is so high, the incentive to return the mine to legitimate control is zero. Why would they give it back? It is a gold mine, literally and metaphorically. This event forces us to ask a difficult question about the future of all resource extraction in unstable jurisdictions. If this can happen in a major project like Pánuco, what stops it from happening in Peru, in Chile, in Africa? The answer is nothing. We are entering an era of resource nationalism, but not the kind led by governments. This is resource nationalism led by non-state actors. As the value of commodities rises against the collapse of fiat currencies, the incentive to seize these assets becomes irresistible. We will see more of these kinetic events. We will see mines becoming fortresses, requiring private armies to operate. This adds a massive premium to the cost of production. The era of cheap silver, subsidized by peaceful global trade and secure supply lines, is over. The cost of extraction now includes the cost of war. This cost must be passed on to the consumer. The price of your smartphone, your solar installation, your electric car is about to reflect the cost of the security detail in the mountains of Mexico. Inflation is not going away. It is being baked into the very geology of the supply chain. The reaction of the legacy media to this event has been predictably muted. They treat it as a crime blotter item. They do not understand the systemic risk. They do not see that the entire edifice of the green transition is built on a foundation of silver that is largely sourced from these vulnerable regions. They talk about carbon credits and ESG scores, while the physical reality of the mine involves armed checkpoints and abductions. The cognitive dissonance is staggering. The ESG mandates that discouraged investment in North American mining and refining have forced the supply chain to rely on these high-risk jurisdictions. We outsourced the dirty work of mining to places where we thought we could ignore the reality. Now, the reality is staring us in the face. The hypocrisy of the Western environmental movement is being exposed by the brutality of the resource war. We wanted clean energy, but we didn't want mines in our backyard. So now our energy future is held hostage in someone else's backyard. The implications for the investor are binary. You are either holding the physical asset or you are holding a liability. A mining stock is a claim on a future stream of cash flow from a hole in the ground. If that hole in the ground is seized, the stock is zero. A futures contract is a claim on a delivery mechanism. If that mechanism is broken, the contract is void. Only the metal in your possession is immune to this risk. The events in Sinaloa are a warning shot. They are telling you that the counterparty risk in the mining sector has just spiked to levels not seen in decades. The jurisdiction risk is no longer a footnote in a prospectus. It is the primary driver of value. Capital will flee these zones, further starving the industry of the investment it needs to expand production. This creates a self-reinforcing loop of scarcity. Less investment means less supply. Less supply means higher prices. Higher prices mean more incentive for seizure. The cycle spirals upwards, carrying the price of physical silver with it, while the paper market disintegrates under the weight of broken promises. We must also consider the geopolitical angle. Who benefits from the disruption of the North American supply chain? The silver that is diverted from the West does not disappear. It finds new buyers. The refineries in the East, specifically in China, have no qualms about processing ore from complex sources. They do not have the same ESG constraints. They have a strategic imperative to accumulate resource. It is highly probable that the silver from these seized operations will eventually find its way into the stockpiles of the East, further strengthening their position at the expense of the West. This is a zero-sum game. Every ounce that does not go to a Western factory is an ounce that strengthens a strategic competitor. The cartel is inadvertently, or perhaps knowingly, acting as an agent of geopolitical realignment. They are redirecting the flow of strategic resources away from the dollar zone. This weakens the dollar's hegemony just as effectively as any central bank policy. The timeline for a resolution to this crisis is non-existent. The Mexican government's deployment of troops is a containment measure, not a solution. They cannot garrison every mine indefinitely. The trust has been broken. Foreign personnel will not return to these zones without guarantees that no government can provide. The brain drain from the sector will be immediate. Who would want to work as a geologist in Sinaloa today? The risk premium on human capital is now infinite. This means that even if the mine is physically retaken, it cannot be operated. You cannot run a modern mine with conscripts. You need experts, and the experts are gone. This effectively sterilizes the reserve. The silver is there, but it might as well be on the moon. This is the definition of a supply cliff. We have walked off the edge, and the market hasn't